Good morning, and welcome to the December 2024 meeting of the SEC's Investor Advisory Committee. I'm Brian Shore, and I'm the chair of the IEC. And before we get started, I'd like to turn the microphone over to Andrew, who will conduct a roll call of the committee members.
Thank you, Brian, and good morning to everyone. I'm going to do the roll call alphabetically by last name. James Andrus. I understand James is currently not here, but I understand he intends to attend this afternoon. Christina Martin Fervita.
Here.
Gina Gale Fletcher.
Here.
George Georgiev. George is currently not here, but I understand he intends to attend this meeting later this morning. Colleen Honigsberg. Colleen? Can you hear us?
Yeah, I can. Sorry, I was running out for coffee.
Craig Kanoki.
Here.
Christine Lazaro.
Here.
Nancy Lemon.
Here.
Amy McGarity.
Here.
Andrew Park.
Here.
Dr. David Royney. Dr. David Royney is not here. Paul Roy.
Here.
Brian Shore.
Here.
Jennifer Schultz.
Here.
Andrea Sight.
Here.
Alvin Velasquez.
Here.
That completes the roll call. Back to you, Brian.
Thank you very much. Today's meeting presents a robust agenda. We will have two timely and compelling panel discussions, as well as one recommendation. Our morning panel, beginning shortly, will be moderated by Christine Lazaro. Christine is the chair of the IEC's Disclosure Subcommittee and a professor, vice dean, and director of the Securities Arbitration Clinic at the St. John's University School of Law. The panel is going to examine the use of mandatory arbitration clauses by registered investment advisors, and it will be building on the June 2023 report of the Office of the Investor Advocate and the Office of the Ombuds entitled Mandatory Arbitration Among SEC Registered Investment Advisors. The report detailed the office's study of the occurrence of mandatory arbitration clauses in SEC registered investment advisor agreements, the occurrence of certain restrictive terms in those mandatory arbitration clauses, such as damage limitations and class action waivers, the frequency of SEC registered advisor arbitration, the frequency of unpaid arbitration awards among SEC registered advisors, and finally, the effects of mandatory arbitration clauses on clients harmed by their investors. This panel will continue the examination of this issue from the perspectives of various stakeholders and will compare the use of mandatory arbitration clauses by state-registered and FINRA-registered broker-dealers. We will then break for an administrative session from 12:30 to 2, followed by the afternoon panel, Mainstreaming of Alternative Assets to Retail Investors, which will begin at 2 p.m. The session will be moderated by Andrew Park, chair of the IEC's Market Structure Subcommittee and Associate Director for Private Equity and Capital Markets of Americans for Financial Reform. Retail investors have increasingly been offered investments in alternative assets, which encompasses non-traditional assets such as private equity, venture capital, private real estate, commodities, and private credit. Alternative assets potentially offer uncorrelated, less volatile returns to traditional investments in the stock or bond markets, but also may face issues around valuations, fees, liquidity, loss of invested capital, and conflicts of interest. This panel will examine those issues as well as the various ways retail investors, who typically are not able to directly invest in alternatives, are now able to do so through, among other vehicles, closed-end funds, interval funds, business development companies, non-traded REITs, and exchange-traded funds. Following the afternoon panel, the members of the IEC will hold a discussion regarding a possible recommendation on the protection of investors and their interactions with influencers. I look forward to our excellent panel discussions and the discussion regarding our recommendation. But now we're going to turn to opening remarks from the chair and commissioners. First, I'll call on Chair Gensler for opening remarks.
Thank you, Brian. Good morning. I'm pleased to meet with the Investor Advisory Committee. As today's meeting is the last that will happen, these quarterly meetings in this administration, I'd like to share some reflections on the committee itself and the importance of this committee to everyday investors. As is customary, I note that my views are my own as the 33rd chair of this SEC, and I'm not speaking on behalf of my fellow commissioners or the staff. Look, when President Roosevelt worked with Congress and enacting the securities laws in the 1930s, they had lived through the 1920s when hucksters, fraudsters, scam artists, Ponzi-like schemers took advantage of investors. They learned what happens when unregulated markets were left on their own, and they understood that protecting investors was critical to the functioning of capital markets. In 1937, 3 years after this agency was set up, the SEC's third chair, William O. Douglas, went further in speaking of the importance of the SEC in fulfilling Congress's vision. At his first press conference, he told members of the press that in this country, quote, "We have got brokers advocates. We've got exchange advocates. We've got investment banker advocates, and we are the investors advocates," end quote. He was referencing the SEC. I think his words are every bit as relevant 87 years later. We at the SEC are the investors advocates. Now, protecting investors is fundamental to each part of the SEC's current three-part mission. The first part, of course, of our mission is, in fact, to protect investors. That's pretty straightforward. At its core, though, investor protection also helps promote trust in our capital markets. And in promoting such trust, it undergirds the second part of our mission, which is to promote fair, orderly, and efficient markets. How can something be fair and orderly if investors don't trust in the market? And the only way to truly have fair, orderly, and efficient markets is to look out for investors. Now, as to the third part of our mission, investor protection is also fundamental to that, which is facilitating capital formation. You see, issuers, companies, and others raising money in our public markets and in our private markets under the securities laws benefit when the public trust in the markets and the willingness to participate in the offerings. The committee, in its current form, is a direct result of a breakdown in those markets, as witnessed in the financial crisis of 2008. And as part of the Dodd-Frank reforms enacted after that crisis, Congress mandated the creation of the Investor Advisory Committee in Section 911, if I recall. And though the SEC had benefited from earlier advisory committees, and there were robust committees prior to that, Congress created this committee to ensure that investors are able to make their voices heard in the Commission's policy deliberations. So the SEC may be the investor's advocate, but we benefit from hearing directly from investors, and this committee has a role in helping us hear from investors. During my tenure as chair, the committee has raised important issues concerning everyday investors, including protections for older Americans, for self-directed investors, and for those investing in special purpose acquisition companies, just to name a few. Today, you'll be continuing in that tradition and advise the Commission on mandatory arbitration clauses, as well as the risk and opportunities of everyday investors investing in alternative assets. And I understand that you'll also be discussing a recommendation regarding so-called finfluencers or influencers in the financial world and social media. Investor protection promotes trust in our securities markets. It's what brings investors and issuers to the markets, sort of like fans watching in a football game. It's what underpins the world's largest capital markets, and it's what has contributed to our nation's great economic success these last 90 years. That's why I felt so privileged to lead this mission-driven agency. And gosh, the staff of this agency is just so dedicated to each part of this three-part mission. And I've been so proud to be part of that on behalf of the American public. I think it's fitting that William O. Douglas's words have long hung on a plaque outside the chair's office at the SEC. I didn't place it there. I don't know which chair placed this plaque outside of the chair's office, but from the third chair to the 33rd chair and beyond, the importance of investor protection transcends, I think, eras. It transcends markets. I think it transcends commissions. This committee's work gives those words, "We are the investor's advocate," added weight. I thank all of the members of this committee for your willingness to serve and for sharing your important perspectives on behalf of investors. Back to you, Brian.
Thank you, Chair Gensler. Thank you for your support of this committee, and thank you for all you've done on behalf of investors across the country. Next will be Commissioner Peirce for opening remarks.
Thank you, Brian, and thank you, Chair Gensler, for a nice opening statement. As we close out 2024, allow me a moment to thank you for sharing your time and your wisdom over the past year. I'm looking forward to working with all of you next year, which is likely to be a particularly eventful year for both the Commission and this committee. Thank you also to the panelists who are joining today to discuss arbitration and alternative assets. Last year, the Office of Investor Advocate and the Office of the Ombuds published a report concerning the use of mandatory arbitration clauses by registered investment advisors. Though inconclusive as to the effects of mandatory arbitration on our advisory clients, the report suggested, quote, establishing uniform disclosure requirements for advisor arbitration information. A disclosure regime can easily morph into a prohibitory regime. Today's discussion, therefore, should not lose sight of the importance of allowing investors and their advisors to choose binding arbitration to resolve disputes. Freedom of contract is a bedrock principle, of course, and submitting a dispute to arbitration is, in many instances, a cheaper and less burdensome process than litigation. As Professor Todd Zawicki has pointed out, although contractual provisions to arbitrate disputes are initially agreed to by contract, a substantial body of common law regulation has been built up by courts to ensure that arbitration processes are fair and effective alternatives to lawsuits. Today's second panel will take up some of the many questions associated with increasing retail investor opportunities to invest in alternative assets. For too long, misguided efforts to shield retail investors from risk have prevented them from directly accessing private market opportunities. Exploring how retail investors can gain diversified exposure to alternative assets with professional advice through existing products like ETFs, interval funds, BDCs, and closed-end funds is a worthy topic for the IAC. The committee also will consider a draft recommendation, as you heard, concerning the protection of investors from so-called finfluencers. As the draft acknowledges, some finfluencers assist investors in understanding complex financial information in clear and digestible social media content. But others are nothing more than a digital twist on the aging actors and gone-to-seed athletes found on any late-night cable channel fronting for a boiler room. Today's finfluencers may be talking about crypto on social media, but the concept is the same. All investors should, of course, exercise good judgment, skepticism, and circumspection before putting their money at risk. To that end, the Commission plays an important role in ensuring that investors have the information they need to make thoughtful decisions in step with their goals and risk tolerance. The Commission has successfully brought enforcement actions against finfluencers for alleged securities law violations. The draft makes some useful recommendations for further action. For example, the draft recommends that the Commission explore possible gaps in disclosure requirements, work with the Federal Trade Commission, make investors aware of finfluencer misconduct, and educate would-be finfluencers about the rules. But some aspects of the draft are much less compelling and raise numerous questions. The first is, of course, is there really a gap to fill? The second, what is the scope of the recommendation? For example, is the committee recommending that we require all finfluencers register as investment advisors, or is it focusing only on finfluencers that are associated with investment advisors? Has the committee considered the draft recommendations, which seem to suggest that we have too much regulated online speech through a First Amendment lens? Should the mere mention of one's holdings in a tweet really be prescribed because followers might buy those same securities? Should the SEC really require a person posting investment musings on a social media site to accompany such musings with, quote, regulatory status, educational background, and business experience of the finfluence or lack thereof? Should social media posts give rise to Section 12 seller liability, as the recommendation suggests? Does the SEC have the authority to demand information from social media platforms to understand their controls for monitoring problematic finfluencers' activities, as the recommendation, draft recommendation suggests? And even if it does the SEC, even if the SEC does have the authority to do this, couldn't attempts to control social media platform content turn into censorship? Would the recommendation to work to establish an international baseline set of requirements that would apply to all finfluencers all over the world be wise in a world where other jurisdictions accept censorship that would be patently illegal in the United States? As the draft recommendation acknowledges, social media and innovative technologies have fueled the welcome influx of new investors into our markets. Emphasis on the potential mischief that can be perpetrated on apps and social media sites ignores that these platforms also enable investors to learn from others' experiences and be warned of dodgy products and untrustworthy voices. If we want to serve these new investors, we should focus on upping our game and becoming a bigger presence online rather than otherizing apps and platforms and infantilizing new investors. One thing the Commission can do immediately is reinstate OIA's standalone social media accounts, which proved to be a very effective way to alert and inform investors. We also could right our multi-year failure to elucidate clearly what a security is, rather than expecting musicians and athletes to become Howie experts before they tweet. I'm always ready to be persuaded, however, and look forward to all of today's discussions. I want to thank Brian Shore and the other members of the committee for their dedication, as well as Christina Martin Fervita, Mark Sharma, Andrew Spork, and Adam Moore, and the countless others here at the Commission for their hard work in putting together today's meeting. Thanks so much.
Commissioner Peirce, thank you very much. We look forward to working with you as we head into 2024. Commissioner Ueda for opening remarks.
Well, thank you, Brian, and good morning and welcome to the final Investor Advisory Committee meeting of 2024. This has been a year of transition for the committee. There were a number of changes to committee leadership. A large number of committee members completed their terms and left the committee, and 5 new committee members were appointed. This year as well, the Commission reformed the IAC selection process to foster greater continuity of committee membership by staggering terms, which is intended to limit turnover to no more than 25% in any given year. And this is important. I've been and had the privilege to work with every iteration and combination of the IAC during my career with the SEC, including its predecessor before Dodd-Frank, when it was an advisory committee under the Federal Advisory Committee Act. And I've seen the tremendous impact, or I should say negative impact, it has when you lose 12 or 14 members in a given year. The new committee members come in, and then you have to spend a fair amount of time in a startup phase all over again. In some ways, it reminded me of the movie Groundhog Day. So I am really pleased with these changes, and I do want to give a lot of credit to our investor advocate, Christina Martin Fervita, and her staff, as well as Barbara Roper in the chairman's office, as well as, importantly, Chair Gensler and my fellow commissioners for pushing through these reforms. I think they will really go a long way to improving the effectiveness and institutional memory of the committee. And if this is, as Chair Gensler mentioned, the last meeting of this administration, of the committee under this administration, there's the old adage of leaving something better than when you found it, and that has truly occurred here. So I thank the support of everyone for that effort. And whether you are new to the committee or have been a member for a number of years, thank you for your efforts and commitment. Over the course of the year, the committee has addressed a wide range of topics, and today's panel discussions close the loop on a topic that began at the committee's first meeting of 2024 back in March. At that meeting, the committee discussed the commission's oversight of investment advisors and examined the growth of private markets relative to public markets. At today's meeting, the committee will discuss the use and scope of mandatory arbitration clauses by investment advisors, a topic that was studied by the staff in the Office of the Investor Advocate and the Office of the Ombuds in 2023, and will explore the methods by which retail investors can gain access to private market investments, such as through direct investments in registered funds. I am particularly mindful of the costs associated with the use of mandatory arbitration clauses by investment advisors. The staff study notes states that a notable percentage of advisory committee agreements with mandatory arbitration clauses also impose requirements on the type and/or number of arbitrators. For example, requiring a panel of 3 arbitrators or requiring arbitrators to be affiliated with the securities industry. The report contrasts this practice with FINRA rules for arbitration arrangements between broker-dealers and their customers, which requires panels consisting of a single arbitrator for disputes involving amounts under $100,000. I'll be interested in hearing perspectives on whether arbitrations involving investment advisors and their clients are more costly than necessary, including due to the use of multiple arbitrators when a single arbitrator might suffice. The panel on mainstreaming of alternative assets to retail investors is particularly timely. Just last week, the Wall Street Journal reported that in 2024, private companies have sold more than $6 billion in stock using a tender offer mechanism. By comparison, only $31 billion has been raised by companies in traditional IPOs. In addition, the total number of unicorns, or those private companies with valuations of $1 billion or more, has increased from 47 to 1,250 over the last decade. With the increasing reporting burdens on public companies, including the politicization of annual meetings through special interest shareholder proposals, it is no surprise that the idea of becoming a public company is now less attractive. Consistent with its mission to facilitate capital formation and protect investors, it is incumbent upon the Commission to foster innovation as it relates to providing retail investors access to private markets. The use of registered funds, which are professionally managed by investment advisors subject to a fiduciary duty, is a good start. I look forward to hearing the perspectives of the panelists and committee members as they tackle this important topic. Finally, the committee will be considering a recommendation regarding the protection of investors in their interactions with finfluencers. More individuals are turning to social media for a wide array of information, including financial information. This evolving landscape presents opportunities for individuals to be led astray. But make no mistake, regardless of who you are still subject to the anti-fraud provisions of the federal securities laws. Now, the Commission also has authority to regulate investment advisors, which is statutorily defined as any person who, for compensation, advises others as to the value of securities or the advisability of investing in securities. The definition also captures those who, for compensation and as part of a regular business, issue or promulgate analyses or reports concerning securities. While social media presents new potential pitfalls for investors, the Commission must be mindful of which types of conduct fall within its jurisdictions and which ones it does not. If a finfluencer is an investment advisor, the full range of laws and rules that apply to investment advisors potentially apply to any advice that is promulgated through social media channels. But mere opinions expressed by individuals in an online setting do not necessarily trigger investment advisor status, so the Commission must not exert authority over conduct that does not fall within its statutory remit. Of course, the Commission is fully empowered to educate investors about emerging issues, and perhaps in this case, investor education can go a long way to assisting individuals in making investment decisions that are consistent with their own interests. So I thank you, the committee members, and the panelists for your time in preparing for this meeting. I look forward to hearing the discussions and the readouts that will follow.
Thank you, Commissioner Ueda. Thank you for your highlighting the recent changes to the committee infrastructure, makeup, and selection process. And again, thank you, Chair Gensler and Commissioner Peirce. We look forward to working with you, Commissioner Ueda, again, and Commissioner Peirce in the new year. And Chair Gensler, we wish you all the best in your future endeavors. Thank you. Thank you for your help and support. The next item on our agenda is the approval of the minutes from our September 19th, 2024 meeting, which have been circulated prior to this meeting. Do I have a motion to approve the minutes?
Move approval.
Can I get a second?
Second.
All those in favor?
Aye.
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 Any objections? The minutes are approved. We're going to turn now to our first panel this morning. The panel is examining the use of mandatory arbitration clauses by registered investment advisors. And it's going to be moderated by Christine Lazaro. So let me turn it over to Christine.
Thank you, Brian. So in this morning's panel, as Brian said, we are going to be examining the use of mandatory arbitration clauses, in particular by registered investment advisors. Arbitration has a long history in the securities industry, and especially on the broker-dealer side of the industry. In 1977, the SROs, or self-regulatory organizations, including at the time the NASD, which was FINRA's predecessor, and the New York Stock Exchange, formed the Securities Industry Conference on Arbitration, known as SICA. The purpose of SICA was to develop uniform rules governing SRO arbitrations between broker-dealers and their customers, and it did just that. SICA developed a uniform code of arbitration procedure, which was adopted by the SROs between 1979 and 1980. To this day, that uniform code is the foundation for the FINRA Code of Arbitration for customer disputes. In addition to setting the rules for the use of arbitration agreements, FINRA administers an arbitration forum for disputes involving broker-dealers and their associated persons. Notwithstanding this history, arbitration agreements have not always been enforceable for investment disputes. In 1953, the Supreme Court determined that an agreement to arbitrate future controversies was void under Section 14 of the Securities Act of 1933 because it was deemed to be a stipulation binding the customer to waive compliance with a provision of the 33 Act. In 1987, the Supreme Court overturned its 1953 decision and determined that arbitration of federal securities claims was, in fact, permissible. Following the Supreme Court's 1987 decision, we began to see widespread use of pre-dispute arbitration clauses within brokerage firm contracts. Concerns about arbitration agreements resurfaced in connection with the financial crisis of 2008, and in 2010, Congress adopted the Dodd-Frank Wall Street Reform and Consumer Protection Act, and within it, in Section 921, gave the SEC the authority by rule to prohibit or impose conditions or limitations on the use of agreements that require customers or clients of any investment advisor to arbitrate any future dispute between them arising under the federal securities laws, the rules and regulations thereunder, or the rules of a self-regulatory organization if it finds that such prohibition, imposition of conditions, or limitations are in the public interest and for the protection of investors. Today, there is ample information about arbitration between brokerage firms and their customers. These arbitrations are subject to FINRA rules, as I mentioned, based on the uniform code developed by SICA, and FINRA makes a substantial amount of information about the arbitration process and its outcomes available through its website. However, there is substantially less information available about the use of arbitration agreements on the registered investment advisor side of the industry. RIAs are not subject to any SRO, And therefore, when they utilize arbitration clauses, those arbitrations are not subject to the same types of rules that an arbitration clause used by a brokerage firm would be subject to. In fact, there are few, if any, rules governing what that arbitration can or should look like. Additionally, the arbitrations themselves have little transparency because they do not occur within an SRO like FINRA, which has committed to making its arbitration process fairly transparent. RIAs often designate private forums to administer their arbitration, which means the amount of information available about the processes are different than those from FINRA and may be inconsistent from arbitration forum to arbitration forum. Following concerns raised anecdotally by investor advocates and others, in January 2023, the SEC's Ombuds Office, in coordination with the Office of Investor Research and the Investor Advocate and Office of Chief Counsel, launched a study to evaluate the occurrence of mandatory arbitration clauses in SEC registered investment advisor agreements, the occurrence of certain restrictive terms in mandatory arbitration clauses, such as damage limitations and class action waivers, the frequency of SEC registered advisor arbitration, the frequency of unpaid arbitration awards among SEC registered investment advisors, and the effects of mandatory arbitration clauses on clients harmed by their advisors. Today, we will hear more information about this study, its findings, and its recommendations by our first speaker, Stacey Puente. Ms. Puente currently serves as the Ombuds of the Securities and Exchange Commission. In that role, she's responsible for evaluating the effects of proposed SEC and self-regulatory organization rules on retail investors, acting as a confidential liaison between retail investors, other federal financial regulators, and the SEC, and reporting to Congress about issues affecting retail investor protection. After we hear about the details of the study, we will hear from industry and investor advocacy stakeholders. First, we will hear from Kevin Carroll. Mr. Carroll serves as Deputy General Counsel, Litigation and Private Client Legal, advising SIFMA's Private Client Legal, Litigation Advisory, and Arbitration Committees. Our next intended speaker, Robin Traxler, the Senior Vice President, Policy and Deputy General Counsel for Financial Services Institute, or FSI, is unable to join us this morning, but has submitted a written statement for the committee's consideration. I've asked committee member Paul Roy to read her statement for the record following Mr. Carroll's remarks. We will next hear from Adam Ghana, partner at Ghana Weinstein LLP and president of the Public Investors Advocate Bar Association, also known as PIABA. Importantly, SIFMA, FSI, and PIABA all met with the Ombuds Office and contributed information and views on the issues addressed by its study. Mr. Carroll and Mr. Ghana will discuss the extent to which registered investment advisors are utilizing mandatory arbitration clauses in their client agreement, the commonalities and differences among the agreements used, and the harms and benefits of such clauses. We've had a challenge with another one of our planned speakers, Professor Nicole Iannarone, an associate professor of law at Thomas R. Klein School of Law at Drexel University. She is also unable to join us this morning. Professor Iannarone had planned to provide an overview of FINRA rules governing the scope and use of mandatory arbitration clauses by broker-dealers and discuss the differences between those rules and the standards governing the use of mandatory arbitration clauses by RIAs. While Professor Iannarone will be able to submit a statement following this panel, I will briefly provide an overview of the relevant FINRA rules that govern broker-dealer arbitrations for the context of the broader discussion. And finally, we will hear from Stephen Bray of the State of Michigan Department of Licensing and Regulatory Affairs, Corporation Securities and Commercial Licensing Bureau, Securities and Audit Division. He's also the Vice Chair of the Investment Advisor Section Committee and co-chair of the Investment Advisor Regulatory Policy and Review Project Group at NASA, the North American Securities Administrators Association. Mr. Bray will discuss the state regulatory perspective on the use of mandatory arbitration clauses by state registered investment advisors. Following these presentations, we'll have an opportunity to take questions from the commissioner, staff, and the members of this committee. So now to begin, I will turn it over to Ms. Puente to discuss the SEC study.
Thank you, Christine, and good morning, everyone. It's a pleasure to be here with you today. My name is Stacey Puente. I currently serve as the Ombuds of the Securities and Exchange Commission. And in that role, my team and I primarily serve to respond to and resolve complaints that the public poses related to the SEC and the self-regulatory organization subject to SEC oversight. And before we begin today, I'm obliged to issue the standard disclaimer, which is to say that any views expressed today are my own and do not reflect those of the Commission or of the Commission staff more broadly. So let's begin. Next slide, please. So the study actually began in December of 2022, when the House Committee on Appropriations directed the SEC to determine various issues relating to advisor arbitration, specifically the occurrence of mandatory arbitration clauses and retail investment advisory agreements. That's significant because retail investors primarily invest on behalf of themselves and their households. They also directed us to study the usage of specific restrictive clauses in mandatory arbitration agreements, which Christine has already laid out, but I'll quickly cover here. Those would be forum designation clauses, venue designation clauses, class action waivers, claim limitations, damage limitations, and fee shifting provisions. The committee also directed us to study the incidence of arbitrations and unpaid awards against SEC registered investment advisors over the last 5 years, and to determine the effects of mandatory arbitration agreements on investors that were harmed by advisor misconduct. Our office, along with the Office of the Investor Advocate, were tasked with leading the study, given that we had received numerous anecdotal complaints over the years regarding the usage of mandatory arbitration clauses. Next slide, please. So just a little bit about the methodology that we used for the study. To determine the occurrence of mandatory arbitration clauses, we reviewed and collected 579 randomized retail investment advisory agreements, then compiled the data from those agreements that related to the terms that were specified previously. To correct for any potential non-representativeness of the sample, our economists used inverse probability weighting. As we'll discuss later in this slide deck, we were unable to actually quantify the incidence of SEC registered advisor arbitration, unpaid awards, or the effects of mandatory arbitration generally on harmed investors because there is no publicly available or aggregated source of information about advisor arbitration. And we were unable to identify a representative or randomized sample of harmed advisory clients. So as a proxy for the perspectives of these advisory clients, we interviewed 8 external stakeholder groups identified as having information or expressing views related to the subject of mandatory arbitration. Next slide, please. As Christine mentioned earlier, PIABA and SIFMA, as well as FSI, were among those stakeholders that we interviewed. I should mention that before moving on. In terms of our findings, we preliminarily determined that 61% of the advisory agreements we reviewed included mandatory arbitration clauses. And of those, 92% designated a specific dispute resolution forum. The most predominant was AAA, the American Arbitration Association, followed by FINRA, the Financial Industry Regulatory Authority, then by JAMS at 6%, and other constituted 1% of the clauses in the advisory agreements we reviewed. Next slide, please. Of the agreements that designated specific fora, we found that 37% designated specific forum rules. So I should probably take a second to distinguish certain types of rules from other types. So in certain situations, there are what you would call generally consumer rules of arbitration. And then you might distinguish those from what we would call commercial rules of arbitration. Consumer rules are meant to be used typically when you have a consumer that is arbitrating a dispute with a larger corporation. Commercial rules are typically relegated for instances where a business-to-business dispute occurs. So you wouldn't necessarily expect to see them in arbitrations where an advisor is arbitrating with their client. Nevertheless, we did see when an agreement designated specific forum rules, 83% of the time, those agreements designated AAA commercial rules. Now keep in mind, these commercial rules are intended for business-to-business disputes and business-to-business transactions. 3% designated JAMS streamlined rules and procedures, 2% JAMS comprehensive rules and procedures, and 1% AAA's security arbitration supplementary procedures, which I believe are no longer in existence. Next slide, please. Thanks. When an agreement designates an arbitration venue, we found that occurred initially 60% of the time. And when I say arbitration venue, that is the location of an arbitration. So in 60% of advisory agreements, the agreement designated an arbitration venue. Significantly, we found that when the agreement designated a venue, 97% of the time, the agreement did not consider the client's location or place of business. So for instance, we might say, or we might have seen situations where the agreement suggested or stated that the arbitration would need to take place in the location where the advisor was headquartered or where the advisor was. And you might be able to see that in certain situations, if the advisor is located, say, in Alaska and the client is located in Florida, and the venue is designated as the location of the advisor, there might be some travel that would be required for any arbitration to take place, and costs related to that travel that the client would have to incur. Next slide, please. We also were asked, as we stated previously, to identify the frequency with which certain terms were used. And so in this situation, and again, I should reiterate that these were situations where the advisory agreement contained a mandatory arbitration clause. So when it did, we found that 6% included class action waivers, 5% limited the types of claims that might be asserted against the advisor, 11% included damage limitation clauses, which would limit the types of damages that might be awarded against the advisor, and 18% included fee shifting provisions such that the prevailing party in the arbitration would be able to have their fees and costs shifted to the losing party in the arbitration. Next slide, please. So we were also asked to find the incidence of advisor arbitration, unpaid awards over the last 5 years, and the effects of mandatory arbitration on harmed investors. But we were unable to do so due to the lack of any publicly available or aggregated sources of information. This is due to a variety of reasons. First, SEC registered advisors are not explicitly required to disclose arbitration information in their forms filed with the SEC. Rather, they are required to disclose material information relating to the advisory relationship, and materiality is determined by the advisor itself. Also, the arbitration fora that are typically selected, such as AAA and JAMS, by advisors do not track advisor arbitration information. They also don't disclose awards, and therefore there was no usable source of data that we were able to obtain from AAA or JAMS. We conferred with FINRA as well to determine the incidence of dual registrant arbitration, but it was unreliable for purposes of the study because it might involve the brokerage business of the dual registrant or other atypical circumstances. We consulted with NASA as well, but that information was also unreliable for purposes of the study as it would relate to state registered advisors and individual advisor representatives. Next slide, please. So instead, as I mentioned earlier, we solicited the perspectives of stakeholders who were invested in this issue and had expressed specific perspectives on this issue to obtain a sort of proxy perspective for the investors that had undergone mandatory arbitration with their advisors. So we interviewed 8 external stakeholder groups, and those stakeholders included the American Association of Individual Investors, Better Markets, FINRA, Financial Services Institute, Investment Advisor Association, North American Securities Administrators Association, PIABA, and SIFMA. Next slide, please. During the course of our interviews, we were able to obtain some, I guess you would say, agreement among the stakeholders on a couple of different issues, but for the most part, there were divergent perspectives which are captured in the slide deck. I think stakeholders generally agreed that mandatory arbitration benefited advisors. Where they differed was whether the benefits to advisors inure to the benefits of their clients as well. So from the perspective of proponents of mandatory arbitration, generally clients and advisors would both benefit from mandatory arbitration because it simplified the dispute resolution process. For instance, it limits access to discovery between the parties. It forecloses the right to appeal. It also maximizes privacy during and after the arbitration, and it increased the predictability and efficiency of the process by designating a known arbitration forum with familiar rules. Next slide, please. So on the other hand, the critics of mandatory arbitration generally believed that mandatory arbitration agreements were contracts of adhesion that benefited advisors at the client's expense. So while the forum rules and the forum itself might be familiar, the argument here was that advisors unilaterally select the forum, the rules, and the venue, which can sometimes increase the costs and inconvenience for the client and favor the advisor. And specifically, the use of restrictive terms like claim limitations that are permissible in some of these fora might actually violate the fiduciary duty owed to clients. The limited discovery that is typical in arbitration might limit client access to evidence. And these critics also argued that the lack of appeal prevents the review of arbitrator decisions in virtually every situation. Next slide, please. All right, so with respect to disclosure, we also had varying perspectives, which are captured here on this slide. But as a general matter, it's worth noting that SEC registered advisors, again, are not required to disclose information about client arbitrations, whereas brokers, state registered advisors, and individual advisor representatives are required to disclose this information in certain circumstances. Most stakeholders agreed that advisor disclosure about client arbitrations should be more consistent generally. Proponents of mandatory arbitration expressed that advisors must already disclose information material to the advisor relationship, which would include some arbitration information. But they also agreed that more consistent, full and fair disclosure of allegations about relating to client arbitrations that the advisor deemed material would create a competitive advantage for honest advisors and promote fairer markets. For critics of mandatory arbitration, they asserted that the lack of uniform disclosure requirements for advisor arbitration information might allow recidivist advisors to conceal client allegations of wrongdoing from regulators and prospective clients. They also asserted that advisors' fiduciary duty necessitated the disclosure of customer arbitration information, irrespective of whether the advisor deemed the information to be material. Next slide, please. Several critics of mandatory arbitration asserted that there were differences between the advisor and broker arbitration regimes that actually disadvantaged advisory clients. So for instance, some of the restrictive terms that we've already discussed are impermissible in agreements between brokers and their customers, and the terms could negatively affect arbitral outcomes for advisory clients. In addition, the cost of private advisor arbitration, where commercial rules are often invoked, are higher than the costs of broker arbitration through FINRA. The FINRA Code of Arbitration Procedure requires customers to resolve disputes with brokers through the rules for customer disputes, precluding the usage of the rules for industry disputes in FINRA. And it also precludes usage of some restrictive terms used in advisory agreements. Next slide. All right, so with regard to the usage of restrictive terms, I'll refer back to the data presented in a previous slide. Class action waivers, you might recall, occurred in 6% of mandatory arbitration, 6% of RIA agreements with mandatory arbitration clauses. They are not permissible in brokerage agreements. Similarly, claim limitations appeared in 5% of RIA agreements with mandatory arbitration clauses. They are not also permissible in brokerage agreements. Net damage limitations appeared in 11% of these agreements, also not permissible in brokerage agreements. And lastly, the venue selection terms that disregard the client's location, frequently in favor of the advisor's location. Those terms occurred in 97% of these agreements, and they are also impermissible in brokerage agreements. Next slide, please. In terms of the cost, it's instructive to look at just the initial filing fees and compare the just the AAA commercial arbitration rules and the filing fees associated with arbitrations under those rules with the filing fees that one would incur under the FINRA Code of Arbitration Procedure for customer disputes. So for a matter valued up to $1,000, the minimum filing fee in FINRA Dispute Resolution Services is $50. In AAA, under the commercial arbitration rules, for matters valued up to $75,000, even if it is a matter valued at $1,000, the minimum amount of filing fee that one would have to pay is $925. Sort of in the middle, matters between $50,000 to $100,000 in FINRA, the filing fee there, $975. In AAA, for matters valued between $75,000 and $150,000, filing fee is $1,925. At a maximum in FINRA, for matters valued over $5 million, the claimant would have to pay a filing fee of $2,300. In AAA, under the commercial arbitration rules, the maximum is $11,000, but that is for matters valued over $10 million. For matters between $1 million up to $10 million, the initial filing fee alone is $7,700. With respect to the arbitrator fees, the arbitrator rates are scheduled by FINRA and established by FINRA. Under AAA and also in other private arbitration fora, arbitrators are allowed to set their own hourly rates. There's no, AAA does not control or have authority over the rates that arbitrators set in those fora. Next slide, please. So one thing I want to say is that in our initial report, we did not include any conclusions or recommendations. These conclusions and recommendations, however, can be found in the Investor Advocates Report on Objectives for fiscal year 2023, which was published last December 2023. I will include a link to that report later on during this discussion, if anyone should wish to refer to that. It has a lot more information than I was able to condense into this slide deck for today, but I would encourage you to read it. After weighing the information, after consideration of all the information, and after conducting our inquiry into the costs and associated with the different types of arbitration and a comparison of the rules between advisor arbitration and broker-dealer arbitration, we came to a series of conclusions and recommendations based on our findings. Number one, the SEC should require consistent disclosure of customer arbitration information for SEC registered advisors and broker-dealers to decrease investor confusion and promote regulatory clarity. As I've mentioned before, these disclosures are already required for broker-dealers, state registered advisors, as well as individual advisor representatives. So the SEC might consider harmonizing the disclosure requirements for registered investment advisors across state, IAR, and broker-dealer lines. However, even if disclosure is required among SEC registered advisors, the disclosures would be difficult to evaluate. It would be difficult to ascertain the truth or the fulsomeness of the disclosure, given the privatized nature of advisor arbitration and the SEC's lack of jurisdiction over private arbitration fora such as AAA and JAMS. We are able to obtain as an agency information about advisor arbitration because of our relationship with FINRA, and because FINRA itself publishes that information on its website and in other places. The SEC does not share such a relationship with AAA, JAMS, or any other private arbitration fora, making it very difficult to obtain aggregated information or to assess the accuracy of an advisor's disclosure in this area. One of the other findings or conclusions we came to is that the inclusion of these types of restricted clauses that we've discussed previously, like claim limitations, damage limitations, these things are most likely harmful to clients. It's difficult to imagine a situation in which a limitation on claims or limitation on damages would be in the client's best interest. And therefore, we concluded that the inclusion of such terms might violate the advisor's fiduciary duties owed to their clients. I believe, as Christine pointed out earlier this morning, Dodd-Frank permits the SEC to restrict the usage of mandatory arbitration clauses for disputes arising under the federal securities laws, rules, and regulations if it deems it's in the public interest and for the protection of investors. We did recommend in our report on activities for December 2023 that the SEC consider issuing a pause on mandatory arbitration among registered investment advisors until more information can be collected about the issue. However, absent SEC or congressional action, we strongly recommend that investors take measures to protect themselves. This could mean, it should mean actually, that investors should review their advisory agreements for mandatory arbitration clauses and any of the restricted terms that we've discussed previously. You know, there's nothing saying that if a restrictive term appears in the clause, cross it out. That's a form of self-help. It could, at a minimum, start a conversation with you and your advisor. We would also recommend that investors ask their advisors about any client arbitrations or litigations that they have been, in which they have been named as a party. We would also suggest that they research the IAPD database on the SEC's website for any disclosures that might be relevant to their advisor or any other information that might be relevant to their advisor's conduct. And I believe that concludes the presentation. Next slide, please. Thank you. I appreciate your time this morning.
Thank you, Stacy. At this point, I think it may make sense to briefly go into some detail about the FINRA rules that Stacy referenced, which again was intended to be covered by Professor Nicole Iannarone, but I'm going to do very briefly right now. So like we said, there are FINRA rules governing pre-dispute arbitration agreements. Specifically, FINRA Rule 2268 sets forth requirements when a brokerage firm uses a pre-dispute arbitration agreement in connection with a customer account. If a firm utilizes such a clause, it must be highlighted and preceded by prescribed language that FINRA has set. That language basically describes the limitations of arbitration and highlights some of the differences from bringing a case in court. And just as an example, some of that language, I'm going to read just a couple of the provisions that must be included. All parties to this agreement are giving up the right to sue each other in court, including the right to a trial by jury, except as provided by the rules of the arbitration forum in which a claim is filed. Arbitration awards are generally final and binding. A party's ability to have a court reverse or modify an arbitration award is very limited. The arbitrators do not have to explain the reason for their award. And it includes a handful of other provisions. The firm must include a highlighted statement immediately preceding any signature line in the agreement that informs the customer that the agreement does contain a pre-dispute arbitration clause, and specifically indicating where that clause is within the agreement itself. Additionally, FINRA prohibits firms from including conditions within a pre-dispute arbitration clause that limits or contradicts the rules of any SRO, limits the ability of a party to file any claim in arbitration, limits the ability of a party to file any claim in court permitted to be filed in court under the rules of the forum, or limits the ability of arbitrators to make any award. In addition, an arbitration clause may not contain any class action waiver. Further, FINRA rules require that brokerage firms consent to FINRA as an available arbitration forum at the election of the customer, even if another forum is designated within the agreement, and even in the absence of an arbitration clause within the customer agreement. FINRA does set the venue of an arbitration proceeding in the hearing location closest to the customer's residence at the time the event's giving rise to the complaint. If the arbitration is before a single arbitrator, that arbitrator will be a public arbitrator, meaning the person may not be associated with a broker-dealer, the CFTC, the NFA, the MSRB, or an investment company or an investment advisor. In the event the arbitration is held before 3 arbitrators, either party, the customer or the brokerage firm, may elect to have an all-public panel of arbitrators. FINRA has also established a small claims process for claims with damages of $50,000 or less. These are known as simplified cases. These claims may be considered on the basis of written submission or by a specialized streamlined hearing process, which has the effect of significantly reducing the cost of the process and the time frame from filing to decision. FINRA has set the fees for the arbitration process, which differentiate between customers and firms. As Stacy mentioned, FINRA sets the arbitrator rate. It is not an hourly rate, but rather a rate per hearing session, and is consistent across arbitrators. Customers pay a lower portion of the filing fees, and there are member surcharges that are fully paid by the brokerage firm party. FINRA has also established rules governing the timing of filing claims and answers and the types of motions to dismiss which may be filed. And finally, FINRA has established a discovery guide which sets forth the presumptively discoverable documents for both customers and firms, as well as a process by which other discovery requests may be made. Arbitrators are required to issue a written award, although it need not contain any explanation for its decision. And then FINRA makes the arbitration awards publicly available on its website. FINRA also makes available statistics about its arbitration forum. It discloses how many cases are filed each year, month by month, how many cases are resolved, and the average turnaround time from filing to resolution. It includes details about the top 15 controversy types alleged in customer arbitrations, as well as the top 15 types of securities complained about. It also includes details about how cases close, whether it's a hearing, a settlement, a mediation, or by withdrawal or other means, as well as the results of the cases that resolve with an award. FINRA also includes information about its hearing site locations, including the numbers and types of arbitrators available in each location. If an arbitration complaint is filed against a broker or references misconduct by a broker, that complaint must be disclosed on the broker's U4 or U5 and is then made available to the public through broker check. If an arbitration award is issued against a broker, that is also disclosed on broker check, as are any arbitration awards issued against brokerage firms. So this is a brief summary of some of the applicable rules governing brokerage firms when they utilize pre-dispute arbitration clauses. At this point, I'm going to turn it over to Kevin Carroll to discuss some of the perspectives that SIFMA raised and industry perspectives on registered investment advisor use of pre-dispute arbitration clauses.
Thank you, Christine. How's my sound? Can everyone hear me okay?
All good.
Okay, good. I'm Kevin Carroll. I'm a Deputy General Counsel in SIFMA's Office of General Counsel. SIFMA is the leading trade association for broker-dealers, investment banks, and asset managers operating in the US and global capital markets. And on behalf of our industry's 1 million employees, we advocate on legislation, regulation, and business policy affecting retail and institutional investors, equity and fixed income markets, and related products and services. So before I start, first a point on terminology and labels. Labels are important. Generally speaking, opponents of arbitration and arbitration clauses specifically, they call them mandatory arbitration, whereas proponents refer to these clauses more accurately and more descriptively as pre-dispute agreements to arbitrate. If a business designates court-based litigation to resolve disputes, you never hear it referred to as mandatory litigation. So I think the entire conversation around arbitration clauses begins from a point that reflects a certain level of animus towards arbitration and arbitration clauses specifically. There are 3 points I want to make. Point one is that arbitration clauses generally benefit retail customers. Interestingly, and Christine referred to this earlier, the original sin, if you will, of mandatory arbitration is a FINRA rule. It's an SEC approved FINRA rule, and it's been on the books for decades. It's FINRA Rule 12-200. And it requires a broker-dealer to arbitrate if a customer requests, even absent an arbitration clause. Essentially, FINRA and the SEC, by its approval, has imposed mandatory arbitration on broker-dealers. That's a policy choice that FINRA and the SEC have lived with for decades. And as a direct consequence of that rule and that policy choice, broker-dealers generally include an arbitration clause in all of their retail customer agreements. And they do that to ensure some measure of control over their dispute resolution costs and avoid being whipsawed between arbitration and court-based litigation post-dispute. essentially firms do owe it to their customers and their businesses to manage their dispute resolution costs. In fact, both our broker-dealer and our registered investment advisor members often include pre-dispute agreements to arbitrate in their retail customer contracts so they can effectively manage their dispute resolution costs as part of their overall operating expenses. When firms can effectively manage these costs, they can more efficiently price their products and services, and retail customers benefit from this pricing efficiency. That's benefit number one. Benefit two, arbitration clauses provide retail customers with clear and certain information about where future disputes are going to be handled. And a third benefit I would point out is that arbitration clauses benefit retail customers by ensuring dispute resolution costs in an arbitration forum that are generally lower than the costs of court-based litigation. Finally, on point one, from a practical perspective, if you don't include an arbitration clause at the outset of the contractual relationship, then the prospect of a post-dispute agreement to arbitrate is generally less likely. This is so because once a dispute arises, one party or the other will generally see a tactical advantage to suing in court, whether to extract a higher settlement or for other reasons. So, as a practical matter, if you want to ensure that you're going to arbitrate, you'd be well advised to include an arbitration clause in your contract at the outset of the relationship. So that's point one. Point two, and this was brought up earlier, and it's interesting. Point two is that the defining qualities of arbitration do not militate against the use of arbitration clauses. What do I mean by that? Well, the logical fallacy goes that mandatory arbitration clauses are bad because they designate arbitration as the dispute resolution forum. Arbitration is bad, they say, because it doesn't require a written decision. There are no appeals. Discovery and motions practice are limited, et cetera, et cetera. But those qualities of arbitration are really the entire point. Arbitration is generally faster and less expensive than court-based arbitration because of these qualities. Decisions are faster, and final. Customers' sensitive financial business is kept private, and all parties benefit from these qualities. My third and final point is that both firms and retail customers are entitled to prompt and fair resolution of their disputes. This is the central question we're here to discuss today, I think. What is fair and appropriate for both parties? Future dispute resolution is a matter of contract. Firms should remain free to designate a commercially reasonable dispute resolution forum, including arbitration, at the outset of their business relationship. And again, this ensures that firms can control their dispute resolution costs. That's the cost of doing business for every business, whether financial services or other industry. As for retail customers, with respect to arbitration clauses, retail customers should have the benefit of a clause that is conspicuous and designated to put the retail customer on fair notice that future disputes will be resolved in arbitration. With respect to the arbitration forum, retail customers should have the benefit of a forum that provides prompt resolution of their disputes, that provides fair and transparent procedural rules, and most importantly, that delivers fair outcomes. And if the arbitration clause and the arbitration forum designated by that clause deliver on these key elements of fairness, then the use of arbitration clauses benefits both firms and retail customers equally. Thank you. That concludes my opening remarks.
Thank you, Kevin. Now I'd like to turn it over to Paul Roy. Paul is going to present Robin Traxler's statement. And as I mentioned, Robin is unable to join us this morning. but she is the Senior Vice President of Policy and Deputy General Counsel for the Financial Services Institute.
Thank you, Christine. Can can folks hear me?
Yes.
Okay, very good. Yeah, I'm just gonna read her statement. And again, she apologizes for not being able to be on the call. And as Christine mentioned, sorry, um, Christine mentioned she's Deputy General Counsel at the Financial Services Institute. The FISA members are independent broker dealers and independent financial advisors. Sorry, my phone's going off. Okay, I have to cut it off. Sorry about that. So they're FSI members are independent broker dealers and independent financial advisors. Nearly all of the FSI members are duly registered as registered representatives and registered investment advisors or individual advisor representatives. FSI is the only organization advocating solely on behalf of these independent firms and financial advisors. FSI's voice is unique in that it is able to bring the perspective of local independent financial advisors and independent firms to important regulatory issues. Because of the independent nature of their businesses, individual financial advisors registered with an independent broker dealer are contractors as opposed to employees. They own and operate their own businesses and often live in the communities where they maintain their business. FSI members provide affordable, objective advice to hardworking Main Street Americans. And independent financial advisors help their advisors' clients achieve their important financial goals, such as planning for a dignified retirement, saving for their children's education, supporting loved ones in old age, and dealing with unexpected life events such as healthcare issues. The independent financial services community has been an important and active part of the lives of American investors for more than 40 years. In the US, there are more than 160,000 independent financial advisors, which account for approximately 52.7% of all producing registered representatives. These financial advisors are self-employed independent contractors rather than employees of the independent broker-dealer. FSI's independent broker-dealer member firms provide business support to independent financial advisors in addition to supervising their business practices and arranging for the execution and clearing of customer transactions. Independent financial advisors are small business owners and job creators with strong ties to their communities. These financial advisors provide comprehensive and affordable financial services that help millions of individuals, families, small businesses, associations, organizations, and retirement plans. Their services include financial education, planning, implementation, and investment monitoring. Due to their unique business model, FSI members and their affiliated financial advisors are especially well positioned to provide Main Street Americans with the affordable financial advice, products, and services necessary to achieve their goals. FSI members make substantial contributions to our nation's economy. According to Oxford Economics, FSI members nationwide generate $35.7 billion in economic activity. This activity in turn supports over 408,000 jobs, including direct employees, those employed in the FSI supply chain, and those supported in the broader economy. In addition, FSI members contribute nearly $7.2 billion annually to federal, state, and local government taxes. Since 2004, FSI has advocated for a regulatory environment that enhances investor protection and encourages efficient and effective regulation. They do this through constructive engagement with policymakers and elected officials in Washington, D.C. and the states, and they're very appreciative of the opportunity to speak and provide this information for our committee today. She then indicates that she wants to cover the use of mandatory arbitration clauses by registered investment advisors. As an initial matter, FSI does not possess any information or data regarding the scope or use of arbitration in the RIA space, other than what has been published by the SEC's report, which we note is admittedly bereft of comprehensive data itself. We consulted with SEC staff as they were developing the report and ensured they understood that we represent the views of independent broker-dealers. Thus, FSI's perspective regarding the use of arbitration for the resolution of investor disputes is limited to the arbitration of claims against independent broker-dealers and registered representatives before FINRA and the Office of Dispute Resolution. In that regard, while there are pros and cons of the process, on balance, FSI believes that arbitration before FINRA has proven to be an effective mechanism for resolving investor disputes. FINRA operates the largest securities dispute resolution forum in the United States. The resolution of disputes is accomplished through two non-judicial proceedings, arbitrations, and mediation. Arbitration and mediation are two distinct ways of resolving securities and business disputes between and among investors, brokerage firms, and individual brokers, and offer a prompt and cost-effective means of resolving issues. All of FINRA arbitration statistics are public, with some dating back to 2004. As of October of this year, there have been 2,147 new case filings, and 65% of these filings are customer-based, while the other 35% are intra-industry. So far, the total cases filed this year are down 27% from the total number filed in 2023. Our members have supported the use of arbitration based on two key factors. Arbitration is more efficient and cost-effective than traditional court litigation, and FINRA's dispute resolution services are, on the whole, fair to both investors and the industry. To that point, FSI has worked to make improvements to FINRA's dispute resolution services to ensure that it remains fair and effective. In 2013, FSI formed an arbitration task force. As an initial matter, the task force determined that arbitration remained an effective venue for disputes, but FINRA dispute resolution program could benefit from improvements to ensure it remained fair and efficient. The arbitration task force developed suggested changes and improvements, and in 2014, FINRA formed their own arbitration task force. The FINRA task force included a member of the FSI task force, and the two groups engaged on several issues. The FINRA task force issued their final report in December 2015. Several suggested changes and improvements developed by FSI's task force were included in the FINRA task force's final report, and those changes were ultimately made. For example, enhancements to recruitment of arbitrators and their remuneration. Arbitration provides numerous benefits that protect investors while ensuring an efficient and fair resolution process. FSI supports arbitration in general as a preferred alternative to traditional court litigation, emphasizing its accessibility, efficiency, and investor-focused advantages. Accessibility for investors. Arbitration before FINRA has proven to be a less costly option compared to traditional court litigation. Efficiency and timeliness. Arbitration resolves disputes significantly faster than traditional court proceedings. This ensures that investors can receive decisions and potential remedies without enduring years of delays, typically associated with litigation, preserving their financial well-being. Investor-friendly procedures. The arbitration framework such as that offered by FINRA, is designed to be user-friendly, simplify procedures, and the absence of extensive discovery requirements reduce the burden on investors, enabling them to pursue claims with relative ease. Additionally, investor claims are often not limited by a statute of limitations, or at least not to the extent they may be in a traditional court proceedings. Protection of investor privacy. Arbitration proceedings are confidential, safeguarding the privacy of investors. This aspect is particularly important for those who wish to avoid the public exposure associated with court cases. While I am unable to provide the purely RIA perspective on this topic, I hope you have found these comments regarding arbitration in general and the FINRA dispute resolution program specifically of some use. I thank you for the opportunity to share these thoughts and look forward to hearing the thoughts of the fellow panelists. And that concludes our statement.
Thank you, Paul, and thank you for presenting that so we have the full context for this discussion. And again, thank you to Robin Traxler for providing those thoughts and remarks to us for our consideration. Now I'd like to turn it over to Adam Ghana, the current president of the Public Investor Advocate Bar Association, for his remarks.
Thank you and good morning, everyone. Specifically, I want to thank the Investment Advisory Committee for having me here today, and particularly Professor Lazaro for the invitation. I want to thank Chairman Gensler and the Commission for hearing us today. This is an incredibly important issue. As Professor Lazaro said, my name is Adam Ghana. I'm the current president of the Public Investor Advocate Bar Association. We are the largest bar association dedicated to investor protection. I'm also the managing partner of Ghana Weinstein LLP. I've served as the adjunct professor at New York Law School and have represented as lead counsel investors in at least 1,000 arbitrations. I had to count the other day to make sure that that was true, in FINRA, AAA, JAMS, and the NFA, and have represented over 3,000 investors. The opinions I'm rendering here today are my own, so I also would like to make that clear for today. Next slide, please. So the SEC Office of Investor Advocate, Ms. Puente talked about earlier, designated this report in 2023 where they looked at 579 separate investment advisory contracts and came up with statistics about what those contracts contain. And I thought that the report was absolutely fascinating because Piava had been doing something similar, which I'll talk about in a second. And so what you'll find from this report generally, and I won't belabor it because Ms. Puente covered it very well in her remarks, but essentially almost 50% of all contracts designate AAA as the preferred forum across the board in investment advisory contracts. So 61% of investment advisors require arbitration, and approximately 83% mandate AAA arbitration. So it is the arbitration, the preferred arbitration forum of the investment community. They also found that the arbitration agreements designate a particular venue, but that they don't take into consideration where the claimant is. And that's important. So when you think about that, if I have a claimant that lives in Hawaii, but the investment advisor, the registered investment advisor is in New York, the registered investment advisor can require that the claimant fly from Hawaii to have their case heard in New York. That's a problem that we'll talk about anecdotally in a few minutes. You'll find also that that a number of firms require hedge clauses. Hedge clauses limit the legal claims that a claimant can actually bring in arbitration. So while they would have claims available to them in court, those claims become limited in arbitration, and I'll give examples of that in a moment. You'll also find that there are one-way fee shifting provisions, meaning that if the respondent wins, they get all their attorney's fees by contract. If the claimant wins, they get all their attorney's fees by contract. And that is incredibly problematic for a number of our clients, which I'll get into as well. Next slide, please. So we conducted our own study. Our study was not limited to SEC registered RIAs. So for those of you that are unfamiliar, SEC registered RIAs are those that have 100 million in management or more, and then state registered RIAs are under 100 million. So we were not limited to SEC registered RIAs. We reviewed through our organization approximately 189 contracts and determined that 58% of those contracts included arbitration clauses. Many of them designated a specific dispute resolution forum. Again, an overwhelming majority of those preferred AAA arbitration. Those that designated forums often designated specific rules. And these specific rules are going to be important as I go through my presentation in a moment. But 32% or so required AAA commercial rules. Nobody required the consumer rules. 6% required FINRA. And 51% required no particular rule set. We found that 30% designated as particular venue. And interestingly, 60% included hedge clauses, limiting, as we discussed, limiting the legal rights of investors, which is incredibly problematic. Next slide, please. Thank you. So as you can see here, a lot of our findings were similar to the findings of the SEC, except that we found a larger number of firms utilizing hedge clauses and a fewer number of firms designating venue. Next slide, please. So what is the problem with investment advisory arbitration? The problem with investment advisory arbitration, as I see it, are in 8 general categories. 1, the use of hedge clauses. 2, the prohibition against class waivers and group claims. 3, the use of venue clauses that materially affect investors negatively by forcing them to go into a foreign venue to have their claims heard. 4th, choice of law provisions. 5th, one-way fee shifting provisions. 6, inconsistent rule application. 7, costs. And 8, awards are not public because there's no analogous system for the investment advisory community as there is for the broker-dealer community and FINRA through BrokerCheck, which is where you can find all available awards, all awards that have been rendered by FINRA, I believe since at least the 90s, are on their CRD system, and you can find them, and they're all publicly available, and you can review them and look at them and see what happens in FINRA arbitration. There's no analogous system for AAA, and these are incredibly problematic. And frankly, what I find valuable, most valuable from the industry's position through the remarks by Ms. Trexler and Mr. Carroll is that we can all agree that some arbitration is good. That in some cases, arbitration can provide clarity, it can be faster, it can be less expensive, and it can be less opaque sometimes in litigation. But here you'll find in the RIA context, and while you have this sometimes in the broker-dealer context through FINRA, you find this not at all, any of those benefits at all in the RIA context. Now, RIAs have a fiduciary obligation to act in the best interest of their clients. And these clauses aren't in the best interest of investment advisory clients at all. And it's important to note that broker-dealers, who have generally a lower obligation to clients, are required to arbitrate through FINRA, and FINRA almost universally prohibits these clauses or addresses these issues. Also, while those that are for arbitration clauses do sign pre-dispute contracts, those are contracts of adhesion. We have found in my 20 years of experience representing thousands of investors that I've never seen a client negotiate, look at even, or understand their arbitration requirements. I've never seen it. Next slide, please. So I'd like to go through these 8 issues so that the Commission and the IAC fully understands from the investor advocate's perspective what we see are the issues associated with these 8 issues in investment advisory agreements. So the first are hedge clauses, right? So as I explained, hedge clauses limit liability of the firm at the time the client signs the RIA agreement. The investor is waiving their rights, claims, and often the ability to seek certain types of damages just by working with an investment advisor. All RIAs are fiduciaries, yet they can limit the liability at the time of their contract. That is a conflict of interest that must be addressed affirmatively by the SEC. And so you can see we gave you an example of a contract that we were able to pull that says, in this particular arbitration clause, it says that no punitive damages shall be awarded. So while punitive damages may be available to this investor in court, those damages are limited simply by the nature of requiring arbitration. Next slide, please. You can see in this contract as well that this particular investment advisor limited recovery to those that result from the gross negligence or willful misconduct of the advisor. Basic negligent behavior is this particular investment advisor limited damages so that basic negligence would not be recoverable in arbitration, but would be recoverable if this particular client sued their investment advisor and were able to bring a claim in court. So they're limiting their legal rights. And you can see this throughout this contract, that they're limiting the rights that this particular advisor is limiting the rights of its clients to seek redress, legal claims that they would otherwise have. And you can see in point 8.8, neither the advisor nor the client shall be liable for any special or consequential damages related to losses, and so on and so forth. So that is the issue with hedge clauses. Next slide, please. Let's talk about the issue with venue clauses and choice of law clauses. So venue clauses force claimants to bring arbitrations in a specific location. Claimants must incur the expense of traveling to and from hearing locations. I represented a widow in 2010 who lived in the Midwest. She was 78 years old. She had sued her investment advisor. She was forced to fly to San Francisco for a full week for room, board, flights, just to bring her claim against her investment advisor because it called for San Francisco to be the designated forum. You can see here in this particular contract, it calls for the county of Contra Costa in the state of California. This particular contract requires, the next contract you see will require the law of the state of Alabama to be the governing law. And so you can see here that many investment advisors we've found either limit the venue to their specific location requiring the investor to fly to bring a claim, and also limit the laws that are able to be applied to a claim, even if the securities are sold in a different location. Next slide, please. This one is particularly irksome to me, the one-way fee shifting agreements. These clauses state that the investor should be responsible for the RIA's attorney's fees and costs in the event that they are unsuccessful in the arbitration. Potential claimants are discouraged from bringing their claims. And I'll give a specific example that happened now 3 months ago to a potential client that had called me. In that particular case, a client called me with a $400,000 claim that I would have happily brought against her investment advisor. I thought it was an incredibly meritorious claim. However, the firm had a one-way fee shifting provision whereby they would be entitled to their attorney's fees in the event that they won, and also require that the commercial rules apply under AAA, and that the claim be brought in a venue associated with the investment advisor. So as I explained to my client, she might have to pay all the costs associated with the commercial rules, which I'll get to in a second. She might have to pay, if we lose, all of the attorney's fees for the respondent in the event that she loses, which could be hundreds of thousands of dollars. And she might have to pay all the forum fees associated with flying, all the fees associated with flying to the venue to have the case heard. And so there was a chilling effect on her ability to bring an incredibly viable claim for upwards of $400,000. And this is something that no study will be able to see, which is what I think the value of my testimony here today is. These are things that are unquantifiable because the client will call me to bring a claim and then decide to do nothing. That is not a quantifiable metric that the SEC will ever see, ever. Next slide, please. So let's talk about the inconsistency. And this is really where I think the industry hates the current standard for investment advisors arbitration agreements as they currently stand today. Both sides, I think, agree, both investor advocates and the industry can agree that the current status of investment advisory contracts is untenable and, frankly, grossly unfair to investors and to the industry itself. And let me explain why. AAA is the forum of choice for most most RIAs that require arbitration. And essentially 1 and 2, it seems like from the SEC study, contracts have AAA as the designated form, and of that, most of them require the commercial rules. However, under the AAA rules as they currently stand, if an investor, an individual investor, files an arbitration against an RIA, it goes under the consumer rules. Okay? So it goes under the consumer rules where the investor pays approximately $300 and doesn't have to pay any more fees associated with that claim. That's great for the investor. However, most firms don't understand that they then become responsible for all the costs, even though they put the commercial rules into their contract. So what happens? So let me just be clear. If the commercial rules apply, generally speaking, my last commercial rule case, 1 investor, 1 RIA, through a full evidentiary hearing with a standard hourly rate for the arbitrator, each side had to pay for 1 arbitrator $65,000 in costs under the commercial rules. I'll let that sink in for a second. $65,000 in costs. Now, under the consumer rules, the claimant would have to pay $300, and there's a limit on the costs in AAA as to the total amount that is allowed to be charged. And so it would have been less under the consumer rules, but that's what happens under the commercial rules. So which rule set applies is important. So next slide, please. I'm going to give you an anecdotal example of what happened the last time this happened to one of my clients. We filed a case, or a case was filed under the consumer rules. The firm, of course, did not like that because their contract called for the commercial rules. And so they said, that's not fair. I am not going to pay the costs. So they came to my client and said, well, you pay all the costs. And when we said, of course not, we're under the consumer rules, we only have to pay $300, AAA closed the case. So what happens next? We then file a case in court in California, because that's where we were for the arbitration, despite the fact that my client was in Hawaii. We file a case in California, and it takes nearly 18 months, 16, 18 months, for the court to compel the respondent to arbitration. Now, the respondent had, because we're in California, they're bound by California Civil Code 1281.97, which requires now that the respondent now has to pay all the costs and fees associated with the arbitration. Can you turn to the next slide for me, please? They had to pay all the costs and fees associated, attorney's fees associated with the arbitration. We said, great, so we should be getting paid as we go along in the case and everything would be great. So after nearly 2 years, we end up back in arbitration. We end up under the consumer rules. We get a cram down arbitrator because under the commercial rules, you pick your arbitrator, but under the consumer rules, you get a cram down arbitrator, one chosen by AAA. And that arbitrator, after 2 years, after extensive court litigation, determined that we should go back to the consumer rules. Back to the commercial rules rather than the consumer rules. That level of inconsistency is abhorrent. It's untenable and unfair to the investing community and to the investment advisors that also want what I think Mr. Carroll aptly put, a faster form a less expensive form, consistency, and clarity. All things that investors want as well. And I will say very clearly that investors want choice. They want to choose between either litigation or arbitration, and if they're going to be in arbitration, which form to actually be in. We support the Investor Choice Act. However, if we are going to be forced in arbitration, these 8 things need to be fixed. FINRA has fixed them generally for broker-dealers. The investment advisory community and the SEC needs to fix them for investment advisory contracts. Next slide, please. Where else do we see problems? There is a chilling effect on the ability to even bring claims. You can see in this example that was given to me by one of my Piaba colleagues, an 85-year-old claimant was forced to file her claim against her RIA in AAA arbitration. Claimant's counsel followed the AAA consumer rules in filing. The RIA refused to pay the AAA fees and the matter was dismissed. Claimant's counsel filed a court case against respondent. The RIA filed a motion to compel arbitration, blaming claimant for the failed AAA arbitration and claiming that AAA misinterpreted its own rules by requiring the consumer rules rather than the commercial rules, which it didn't, of course. If you read the rules, it's very clear. Court denied the RIA's motion. The RIA appealed, and it's still pending over a year later in court. Again, inconsistent, overly expensive, and slow. All things that the industry wants to fix. Next slide, please. Also, as I was saying earlier, there is a chilling effect on smaller claims. And when I say smaller claims, claims under $500,000, but this is a prime example of the issue. A client loses $60,000 because of RIA mismanagement, allegedly. The RIA firm had a clause requiring the arbitration be pursued through JAMS, a form that has fees of upwards of $25,000 because you have to pay the hourly rate of the arbitrator, and that goes unchecked as well. So if a motion to dismiss, I had a case once where a motion to dismiss was filed, a 3-page order was rendered, and the arbitrator billed 40 hours for a 3-page motion to dismiss at $600 an hour. You all can do the math on that. I don't have to do it for you. That is outrageous, and there's no way to challenge it because what am I supposed to do? That person is the judge and jury of my case, my client's case. Claimant's counsel explained to client that given how high the fees were in comparison to the amount of loss, it was nearly impossible to pursue the arbitration in this particular case. That is not what the industry wants, according to Ms. Trexler's written statement, according to Mr. Carroll's statement, and according to our statement. It is not what anybody wants. There should not be a chilling effect on the legal rights of investors to bring claims simply because they're in arbitration. So the takeaway from what I'm saying here today is that investors should have choice to arbitrate or litigate their claims and be able to choose the form that they litigate or arbitrate in. That said, if investors are required to arbitrate, the system has to be affordable and fair. Required by contract, as Mr. Carroll said. It has to be affordable and fair. We all agree on that. Currently, RIA arbitration is a disaster for investors. The current system is a disaster for the industry at large because it is too expensive and too inconsistent. Unlike in the broker-dealer context, where FINRA is more consistent and faster. I would agree with that. So what can the SEC do to fix it? A commission interpretation of the standard of conduct for IAs that prohibit the use of arbitration clauses that contain these offending provisions would be incredibly valuable. It can also utilize its rulemaking power under Section 921 of the Dodd-Frank Act. As for the publication of awards, they're not published. There's no way to see these things. There's no way for an investor to see, hey, my broker's been sued 15 times for the inappropriate conduct or for theft. There's nothing like that. That is a huge, invaluable resource for investors that is available in the broker-dealer context through FINRA's broker check, but not available to those that utilize RIAs. This too could be a simple fix. Require the production of that information at any time an RIA has been sued to be put on an ADV. create a similar system to broker check. I understand that I come off very passionate about this issue. It's because I see every day the chilling effect associated with these types of arbitrable contracts, arbitration contracts, and investment advisory agreements. They are a problem. They are a scourge of the industry. They need to be fixed. And the SEC is in a prime position to make those changes. Thank you very much for your time today.
Thank you, Adam. And now we're going to turn it over to our last presenter, Stephen Bray, from the state of Michigan.
Good morning, almost afternoon for those of us in the Eastern time zone. For those central and westward, continued good morning to you. My name is Steve Bray. I'm a staff attorney with the State of Michigan Corporation Securities and Commercial Licensing Bureau. I'm also the vice chair of the Investment Advisor Section Committee and co-chair of the Investment Advisor Regulatory Policy and Review Project Group of the North American Securities Administrators Association, mouthful, commonly known as NASA, much easier. I'm grateful to Christine Lazaro for organizing the panel, to the other panelists for their views here today, the Commission and its staff, and the SEC Investor Advisory Committee for including NASA and its members in today's important conversation regarding mandatory arbitration provisions in investment advisory contracts. My comments today reflect my own personal views and may not necessarily represent the official positions of NASA, any NASA member, or the state of Michigan. My goal today is to provide some background on NASA and its members, the investment advisors that we regulate, and the investors that are served by that regulated population. Also, to offer some insight and high-level observations on the use of mandatory arbitration clauses by state-registered investment advisors. I'd like to restate NASA's long-held position that investors should have a choice of forum when it comes to resolving disputes with their investment professionals. Investor confidence in fair and equitable recourse is critical to the stability of the securities markets and long-term investments by retail investors. NASA has argued that participation by retail investors in our capital markets and by extension job growth is directly tied to the level of trust in having a reasonable avenue to seek recovery if they are victimized by securities fraud or other unethical conduct. NASA was organized in 1919 and is the world's oldest international organization devoted to investor protection. It's a voluntary association whose membership consists of the securities regulators of all 50 states, the District of Columbia, Puerto Rico, U.S. Virgin Islands, and Guam, as well as the 13 provincial and territorial securities regulators in Canada and, excuse me, and the securities regulator in Mexico. Over 300 volunteers from NASA's members participate on more than 50 committees and project groups that are organized by regulatory topic. They're supported by NASA's professional corporate office staff, and relevant to today's discussion is NASA's Investment Advisor section, which focuses primarily on issues facing state-registered investment advisors. So who do NASA members regulate, and what investors does that regulated population serve? State securities regulators regulate myriad manner of products, people, and firms, including securities offerings, broker-dealers, broker-dealer agents, investment advisors, and investment advisor representatives. With respect to investment advisors, NASA members divide their regulatory responsibility with the SEC. In general, small advisors, less than 25 million of regulatory assets under management, or RAUM, and mid-sized advisors between 25 and 100 million of RAUM are registered and primarily regulated by one or more state securities administrators. Conversely, larger investment advisors with 100 million or greater of RAUM are generally registered with the SEC and primarily subject to federal regulation instead of state. In some cases, a small or mid-sized investment advisor may be permitted or required to register with the SEC instead of with one or more state securities regulators. In more limited circumstances, a small or mid-sized advisor may be registered with the SEC and one or more states. States have authority to require the registration of most investment advisor representatives or the individuals associated with these firms that are doing business in their jurisdictions, regardless of whether an individual is employed by or associated with a state firm or a federal covered advisor. Data published in NASA's 2024 Investment Advisor Report, which is available on NASA's website, shows that in 2023, state-registered advisors had assets under management of over $361 billion across 17,000 firms, while over 13,000 federal covered advisors notice filed with the states in that year. For state registered firms, the 2024 NASA Investment Advisor Report showed that the overwhelming majority of the state registered shops are small firms, with 83% having 2 or fewer employees, 16% having between 3 and 10 employees, and less than 1% having any more than that. Approximately 78% of clients of state registered advisors are retail investors, while 19% are high net worth investors, with other entity level clients making up the balance. The investment advisors that we oversee are overwhelmingly small businesses that provide advice to Main Street investors. Many of these investors are unaware of the impact of mandatory arbitration provisions, fail to appreciate their significance at the time of entering into a contract, and are powerless to negotiate a different approach to dispute resolution with their advisors due to the general take it or leave it nature of the clauses. While we understand from the data that the advisors that we regulate are small businesses, and the clients that they serve are primarily retail investors, the data does not provide us a complete picture of the use and effects of mandatory arbitration. The SEC's Office of Ombuds and Office of Investor Advocate June 2023 report on the issue acknowledged an absence of available information about advisor arbitration and noted that further inquiry would be required. State registered investment advisors must disclose information about arbitration claims. However, neither state nor federal covered firms must disclose whether they use these clauses in client agreements. Perhaps some additional questions on Form ADV Parts 1 and 2A could shed additional light on the issue and allow for a more informed discussion. Next, I'd like to discuss in general terms how states might view mandatory arbitration clauses in investment advisor contracts, recognizing that there's limited data available publicly to assess the exact nature of the issue. NASA's investment advisors section conducted an informal internal poll of state regulators in 2023 to gather additional information about mandatory arbitration clauses and advisory contracts. Not all members responded to the survey, and while informal, it did offer some insight. State perspectives on mandatory arbitration exist on a spectrum, from some states outright prohibiting them in advisory contracts by rule on one end, to allowing arbitration clauses with few, if any, restrictions on the other. Certain jurisdictions, like Virginia and Ohio, have adopted administrative rules under an APA process that specifically prohibits mandatory arbitration clauses in advisory contracts. Enforcement of these rules often occurs at the registration and examination level when staff approves an advisor's initial registration application, or when a state securities examiner comes across a contract with these clauses on an examination of a firm. Other jurisdictions take the position that their state securities acts have civil liability provisions and that those provisions entitle investors to file actions in a court within their state. Mandatory arbitration clauses would be inconsistent with those provisions or the provisions that prohibit registrants from entering into contracts that would cause investors to waive a right under their statutes. Still others view mandatory pre-dispute arbitration clauses as inconsistent with an advisor's fiduciary to clients. These states focus on client choice with respect to a forum for dispute resolution as a guidepost on the issue. Jurisdictions in these civil liabilities and fiduciary duty baskets would similarly raise the issue at the registration phase, requiring amendments to proposed client contracts before allowing the firm to do business in the state, or requiring amendments to contracts after the offending provisions are discovered on examination. Some other jurisdictions would not take issue with mandatory arbitration clauses themselves, but would instead look to unfair cost assignment or venue provisions within those clauses that would make it difficult, if not impossible, for a client to seek recompense from an advisor. Forcing a client to pursue an arbitration that will cost more to the client than in forum fees or travel costs than the claim is worth is hardly in the best interest of any retail investor. A number of states also reported that they don't encounter mandatory arbitration clauses in advisory contracts in their jurisdiction or do not view them as an issue for investors there. Now, none of the foregoing is intended to suggest that any forum is better or worse than others, but rather to highlight that investors should have the choice of forum when pursuing complaints against their investment professionals. If arbitration truly offers investors the opportunity to more efficiently and fairly settle their disputes, they'll certainly choose that option. But investors should have the choice to pursue remedies in court if that is something that they view as superior to arbitration. While not applicable to the states, Section 921 of the Dodd-Frank Act gives the SEC explicit rulemaking authority to prohibit or limit the use of mandatory pre-dispute arbitration agreements if it finds doing so is in the public interest for the protection of investors. Although Congress gave the SEC an important tool to act in this area, in the 14 years since Dodd-Frank was passed, the SEC has not exercised its authority to conduct rulemaking regarding mandatory pre-dispute arbitration. I believe that the Investor Advisory Committee should urge the SEC to use its authority under Section 921 to provide investors with choice when it comes to dispute resolution forums, or at a minimum, to at least prohibit the use of arbitration clauses that effectively deprive a client of any means of seeking recovery for alleged wrongdoing. I'd like to close where I began by encouraging investor choice of forum to resolve disputes with their advisors, be it arbitration or a court of law. NASA has long supported legislative efforts that would empower investors by giving them a choice when it comes to resolving disputes with their financial professionals. The IAC should recommend that the SEC utilize its Section 921 authority to prohibit mandatory pre-dispute arbitration provisions in investment advisor contracts, or to at least prohibit mandatory arbitration clauses that effectively deprive investors of a chance to have their claims heard in a fair forum. Barring those recommendations, the committee should, at a minimum, recommend amendments to Form ADV Parts 1 and 2A that are designed to gather additional information on the use of pre-dispute mandatory arbitration clauses by advisors. Finally, I would encourage the SEC and its staff to continue engaging with NASA and other stakeholders on this and other issues affecting retail investors. I would like to thank you all for the opportunity to be here today and for listening to the state's perspective. Thank you.
Thank you, Steve. I'd like to come back to Stacy briefly, who would like to make a clarifying comment.
Thanks, Christine. I just want to emphasize that the SEC study was in no way an evaluation of the merits of mandatory arbitration. To the extent that it was discussed, it was in the context of RIA arbitration, specifically in light of the usage of these restrictive clauses, the costs associated with filing fees and that sort of thing, the lack of transparency in RIA arbitration, as well as the lack of a uniform disclosure system regarding RIA arbitration. That being said, I would be interested to hear, I know a lot of the conversation, it seems, has revolved around the merits of mandatory arbitration altogether, but given that the focus of the study was about the use of restrictive clauses and costs, I would be interested to hear, in particular, SIFMA's views on the usage of these restrictive terms, the filing fees associated with those private fora such as AAA and JAMS, and in light of the overall question about fairness that I believe Mr. Carroll referred to earlier today. Thanks.
And I'd like to give Kevin an opportunity to respond before I take questions from the committee.
Thank you. So just a few comments on what I've heard over the last hour or so. It seems clear we do need to collect more information about what types and in what numbers various terms and conditions are being included in investment advisor arbitration clauses. That point was raised by a number of people. To intelligently talk about the issue, we need to understand it in a more fulsome way and not anecdotally, as I think we've kind of discussed it today. Second, I think it would be a terrible idea to ban arbitration clauses. As I alluded to earlier, if you want to ensure that nothing gets arbitrated, then ban arbitration clauses. Everything will go to court. And I don't think many folks think that is a recipe for fairness for retail customers. So I think there's a balance to be struck to ensure there's fairness to whatever dispute resolution forum is designated. And I think that needs to happen on a pre-dispute basis. I think a regime in which investors have the unilateral post-dispute choice of dispute resolution forum, whether it be court or arbitration, is completely unadministrable. Our member firms as businesses can't manage their dispute resolution costs. That's just a cost of doing business. Firms need to have certainty and predictability with respect to that. And in a regime where you could get whipsawed between arbitration or litigation. The customer may want to file a lawsuit, maybe take some discovery, depositions, document requests, maybe say, I don't think I'll fare so well in court. Now I'll just you know, file the arbitration now with the benefit of all that. Things could really get drug out, and it would be very unmanageable, and I think difficult and chaotic. So I think we need to be careful about the approaches we take, and I think it begins with probably further study and getting more details about what exactly we're talking about, and how do we manage fairness for both firms and for investors in ways that don't create incentives for an industry to want to just simply try everything in court versus having an arbitration option that could really benefit investors through a faster and less expensive resolution.
Thank you. I would like to get to our committee members' questions. And I know there are some other thoughts within the panelists, but I'm hoping we can get to those thoughts in connection with the additional questions we have from the committee members. So with that, can I turn it to Paul?
Thank you, Christine. I guess my first question is for Stacy. Your survey indicated that roughly 10% of the firms use the FINRA form process. And I was curious as to whether or not you looked at how duly registered firms, made the decision about, forum. The duly registered firms, if you're a broker dealer, you got to use the FINRA process, but on the advisor side, you got discretion. And I was wondering whether or not you saw that there was a higher percentage of duly registered firms using FINRA because they're familiar with the process. Are you able to dissect that data? And then the second question, and this goes to more information, have you considered using the exam staff to fill in some of the gaps on the data here and providing more information about the use of these provisions by investment advisors?
Thank you, Paul. With respect to your first question and the usage of FINRA by dual registrants as an arbitration fora, we didn't actually look at the specific arbitrations themselves. We looked at the advisory agreements. And so in a situation where firms did designate FINRA, we did find that most, if not all of them, were actually duly registered as broker-dealers and investment advisors. In terms of, what decisions or what factors they would consider in trying to determine whether or not to arbitrate in FINRA, that is, not something that we were able to discuss with the firms individually. With regard to your second question about exam staff, our office is independent of the commission, and for exams to become involved would be a totally separate process. And I think it would require commission approval prior to any such undertaking. Thank you.
Yeah, well, hopefully the exam staff is paying attention to all the focus you put on this issue.
Thank you, Paul.
Okay, I'm still giving committee members an opportunity to ask questions. And while I wait for that, I have a question myself. I was hoping the panelists can talk a little bit more. I know Steve had a concrete suggestion for making some of this information available through amendments to the ADV. But are there thoughts about concretely, to the extent arbitration continues, assuming arbitration agreements are allowed and they designate various fora, whether it is appropriate and how one might go about actually collecting those awards and making them available to the public. And then secondly, in addition to the arbitration awards, just whether or not there are ways to make the parameters of the arbitration agreements themselves available to investors. Is there any information about whether or not RIAs utilize clauses similarly to the way brokerage firms are obligated to highlight the arbitration clauses and differentiate arbitration from court? So I'll leave that to anybody who'd like to answer. Okay.
Sorry, Christine, would you mind repeating the last part of your question?
That is a good question. Whether or not there's any evidence that when RIAs are utilizing arbitration clauses, they highlight them in any way similar to the way brokerage firms are obligated to.
So, just based on our review of the agreements, we often found that they did. And I think there are certain states that require, anytime there's a mandatory arbitration clause included in an agreement of any kind, they require certain font size and it needs to be set out in its own paragraph. California immediately comes to my mind. That said, they weren't uniformly highlighted in any way. And, I think, it largely, I think, would, aside from any requirement of the forum or any requirement of the state, I think it would largely fall onto the advisor in terms of whether or not to highlight those clauses.
Generally speaking, I can say that they're not highlighted in any meaningful way where client investors know their arbitrable or their rights in terms of how they're supposed to sue in the event that they find themselves wanting to pursue a claim against an investment advisor. I can tell you, I can't remember a single client that's ever called me that understood what their rights and responsibilities are contractually with their investment advisor, whether or not they have to arbitrate or not, what form they arbitrate in. And frankly, most of them don't even know where to look in the event that they want that information. And so we have to, as opposed to in the broker-dealer context, in the investment advisory context, the client generally needs to go back to their investment advisor, get their contract, send it to us, have us review it to them to explain their rights, which can sometimes take weeks because many investment advisors, we find, understand that when a client is asking for their new account forms and their opening account documents, that litigation is likely. And so that can take weeks, if not months sometimes, to just be able to inform an investor how they can go about bringing a claim against their investment advisor.
Thank you. Brian?
As chair of the committee, first I want to thank each of the panelists for their opening remarks. With regard to the topic, I think most people would be surprised, most investors would be surprised if they found out that there are different standards and different courses of enforcement rights that they have available to them. I think most investors would probably think that it's pretty uniform, and they don't even think about the distinction between state registered advisors, registered investment advisors, FINRA regulated advisors, and dual hatted advisors. So my question is this: if there was a goal for harmonization, is that a reality, and how do you accomplish it? Can you harmonize the rules so that there's one set of rules regarding liability and liability enforcement, litigation, arbitration, et cetera?
Nobody else wants
I
to?
can take this.
Oh, go ahead, Stacy.
Just preliminarily, I can take it. If you have anything else, Adam, please feel free, or anybody else. So I want to point out that in 2010, the SEC actually amended the Form 80V and amended the disclosure requirements for SEC registered advisors. And in the adopting release, the SEC considered whether to require SEC registered advisors to disclose information about arbitration with their clients. And at the time, the determination was not to require its disclosure, as advisors are already required to disclose material information to the relationship with the client. And the expectation was that if an advisor deemed the arbitration to be material information, that the advisor would self-disclose, and that additional requirements for disclosure would not be necessary. So there was no explicit requirement at the time. Nevertheless, one of the justifications that was used in the release for not requiring disclosure was that there might be reputational harm that the advisor would incur if these types of claims were disclosed in a Form ADV or such, because arbitrations are matters that are decided in equity. And if you reach a decision in equity, it doesn't necessarily mean that you have violated a law. And so the rationale at the time was the reputational harm that might incur would potentially outweigh any benefits gained from disclosure if the advisor had in fact not violated a law. Nevertheless, the same argument can be made for broker disclosure or state investment advisor disclosure or individual investment advisor representative disclosure. And so in my view, that justification is wanting. Again, this is just my view. I would also point out that the SEC reserved the right to reconsider disclosure of arbitration information for advisors in the future. So, that leaves the door open, I believe, in this area.
Thank you. I'm going to turn to Andrea.
It's Christine. I had a couple of questions. Can everyone hear me? Yes. Okay.
Yes.
So my first question is for all panelists. It would appear that arbitration awards could be hyperlinked in the arbitration DRP that is used ADV Part 1B. Hold on, see if that's better. That is used in ADV Part 1B Item 2E, similar to the disclosure in broker check. And so all RIA arbitration awards and DRP data could then be compiled by the SEC because it's just digital data. And also the state securities regulators. Would any of the panelists be opposed to that? Is my first question.
Well, speaking for
Because
SIFMA,
I would not-
obviously it's a
Go ahead, Kevin, I'm sorry.
it's a hypothetical. Like as with any type of rule change, we'd want to see the data, the cost benefit analysis, and then make a determination from there. I'm sure we'd have a lot to say about a proposed change like that.
Anyone else have thoughts on that?
Sure. Well, I do. So like Kevin, we want to see the data, but we actually want to see the underlying data, right? So we want to see these awards. You can see that the SEC is fighting with one hand behind their back when it comes to the collection of information associated with investment advisory arbitration clauses. And from what we're seeing, the data is essential because changes absolutely need to be made. And I think everyone kind of agrees with that. And so getting data on the awards is important. It's publicly available through broker check for broker dealers. And the fact that it's not publicly available for the fiduciaries is just backwards to me. So yes, we would be very much in favor of that on behalf of the investing public.
So Andrea, if I'm understanding your question, you're wondering whether or not we could get actual copies of the arbitration awards hyperlinked similarly to what happens on the broker-dealer side. I think it's hypothetically possible, but given that the private nature of the non-FINRA arbitration fora, it would be hard to actually get copies of them in some instances where you could actually hyperlink it and have a copy of the award if it's all done. And I think it's been really highlighted here today as a benefit of arbitration that it is private, it's not public, it's not something that's going to be available. So I think you would have a practical difficulty in that side of things, just getting actual copies of the arbitration awards to be hyperlinked on the front end to begin with.
Thanks, Steve. Anybody else?
I actually disagree
That,
with
that I'm
Steve a
just,
little bit.
I'm just envisioning, sorry, these narrative fields that you'd have to fill in that you wouldn't have the information about, like what claims or what basis they decided the award on. You'd be literally reconstructing a proceeding that was private and not documented, which is, again, one of the defining qualities of arbitration that makes it faster and less expensive.
Respectfully, I don't see that as true. So FINRA arbitration, I agree, is faster and sometimes less expensive. But AAA arbitration, as I think we've shown here, is absolutely more expensive than litigation, absolutely slower than litigation, and is an absolute disaster. And so to say that there's any efficiencies there is just not true. And hyperlinking awards wouldn't affect that in any way whatsoever. It wouldn't make it any slower or more expensive. And those awards are all publicly available through FINRA for broker dealers. And so I don't understand how there could be any belief that it'd be incapable of doing here. You require it as part of an ADV disclosure, and you hyperlink to it. It shouldn't be that complicated.
I agree, it should not be that complicated. I think practically it very well may be. And I think all of it kind of gets beside the idea of investor choice and whether an investor should be allowed to choose something that's going to be private or public. I mean, I think we're talking about the idea that arbitration is inherently better because it's quicker and more efficient. And that may be the case in some instances. I think we all agree in that. But it's quicker and more efficient for me to go to the grocery store and get a frozen lasagna than it is for me to buy all the ingredients and make it. And I prefer to cook my own lasagna from scratch, but I get to make that choice. And the idea that an investor can't choose their forum because it might give them additional rights or additional opportunities to discovery, the ability to appeal to the extent they get an adverse decision, and yes, the available access to a public decision. I think putting that decision in the hands of investors is probably a better way to go than having it decided on the front end for them in a contract that they may not necessarily understand.
I'm not sure that there's good reason to believe that investors would choose what's in their best interest with respect to post-dispute dispute resolution. I think a lot of them with small claims would choose court, and that wouldn't work out for them. I think that that a lot of them would choose arbitration when that's not the best option for them either. I think any business and any business dealings that you enter into, you should have the right to decide what the economic terms are at the outset of the relationship. And as a side point, I think it's far from clear, and I don't think there's any legal precedent that an investment advisor's fiduciary duty extends to a dispute resolution clause or any other contractual term for that matter in an investment advisor's agreement with their retail investors. I think you should accept at the outset that those economic terms are ones that are matters of contract, and firms need the freedom to be able to memorialize those and have the certainty and predictability that those are the terms that both parties will abide by with respect to dispute resolution, pricing, or every other economic term in the relationship. And we're not talking about, certainly there's a lot of clauses in a customer contract, and to say that investors aren't fully appreciating or reading or understanding the dispute resolution clause, to me, really is no different than saying that they're not reading any other aspect of the contract either. And that applies not just in our industry, but probably in every industry across the board where consumers enter into agreements for goods and services, unfortunately.
Sorry, Karen. Sorry, Kevin. I didn't mean to interrupt. Did you have something else?
No, go ahead, please.
Okay. I did want to point out that you just mentioned that there's no reference point for an advisor's fiduciary duty being linked to contractual terms. And there is actually, from the SEC's perspective, there is at least one case out there about hedge clauses, which I believe Adam pointed to earlier this morning. And in that case, an advisor included hedge clauses in an advisory agreement without demonstrating that they had explained the implications or the meaning of the term to the investor. And the Division of Enforcement found that that was a violation of the advisor's fiduciary duty. So there are instances like this where, you know, it's not exactly on point, but it is parallel, where, you know, there are contractual terms baked in to a contract of adhesion. I don't think anybody here is arguing that the investor has an opportunity to negotiate any of these terms with their advisor. And I think it's incumbent in those situations, this is again my view, that if the advisor is going to impose these terms on the client, that those terms must be to the benefit of the client and not, as you know, in the case of some of these restrictive terms that we're talking about, claim limitations, damage limitations. I think you would be very hard pressed to make the case that these terms are in the best interest of the client.
Okay, we have about 4 minutes remaining. I just wanted to make sure, Andrea, did you have any additional questions?
No, that's fine. I think that they've already addressed what my questions were. You may want to just give them time to do their closing remarks. Thank you, Christine.
Okay. And I think that transitions us very nicely then. So like I said, we have 4 minutes. That's about 1 minute each. If you would like to make any closing remarks, then we'll go in the same order we started with. So I'll start with Stacy.
Thank you, Christine. I'd like to thank the IAC for having me today, and for everyone on the OIAD, everyone on our team that's participated in putting this together. Thank you. This is, I think, an issue of great importance. I think it's a probably the most important issue relating to investor justice, and this is why. The SEC's Division of Enforcement does an amazing job bringing cases against advisors, brokers, financial industry participants who have engaged in wrongdoing. But what I don't know that the public completely understands is that the purpose of enforcement action is to really protect the market interests altogether as a whole. Enforcement doesn't bring actions on behalf of individual investors. They bring actions on behalf of the market to protect the integrity of the market. So that leaves investors with really on their own to advocate for themselves. I should mention that there are instances where enforcement will get what is called a fair fund. And in those situations, they will distribute funds that they've recovered from the wrongdoers to harmed investors. But in the absence of fair funds, the recoveries from enforcement will go to Treasury. And so that, again, that leaves investors on their own to recoup the funds that they've lost. If we are going to say that investors should be relegated to mandatory arbitration, if we are comfortable saying that they must go into arbitrate their disputes with their financial professionals, I think it's incumbent upon us to ensure that they have a fair opportunity to present their claims and a fair opportunity to appeal decisions that might be unfairly or incorrectly decided by arbitrators. There's currently no appeal process aside from moving to vacate an arbitrator decision, as I think everyone is aware. So for that reason, I think there are few issues that are more important to investor justice than this one. I would encourage everyone to read the Investor Advocate study from December 2023. It has more information than I was able to really discuss in this brief conversation this morning, but I'd like to thank my panelists for their views and wish everyone a happy holiday. Thank you.
Thank you. Kevin?
So thanks everyone for inviting me to join today's discussion. I thought it was helpful, thoughtful, and SIFMA, on behalf of our broker-dealer, investment advisor members, and the securities industry generally, we look forward to further engaging with you, all of you, on this important topic.
Thank you. Adam?
I want to sincerely thank you, Christine, for having us, the Investment Advisory Committee, for all your important work on this. I'd like to thank Stacy and her office for their incredible report on this issue. I see firsthand the devastating effects that these contractual obligations have on the investing public. It is incumbent upon the SEC to make meaningful changes in this space. From what I'm hearing from the industry, it is clear that we share many of the same values associated with arbitration, that if investors are required to be in that space, that it should be fair, it should be fast, it should not price investors out of justice, and it should be expeditious. Those are things that we sometimes find in FINRA arbitration that we are not finding in the investment advisory space. Ms. Trexler's comments were very clear that she found all of those things on behalf of the industry, that they found those things in the FINRA arbitration space, but are not finding it in the investment advisory space. Her silence was clear on that issue. It is clear that the industry, that both to the investing public and to the industry, that investment advisory arbitration has failed the investing public. And it needs remedy, and it needs it fast. This is not a situation where we go back and do more studying of the issue. It's been studied. It is clear that there is an issue, and it needs to be fixed. Thank you again for your time.
And very briefly, Steve?
I will be as brief as I can. Thank you, Christine. Thank you to the SEC, staff, IAC. Thank you for having NASA and including us in this important conversation. I just want to restate, forcing a client into an arbitration that's going to cost them more in forum fees and travel costs than their claim is worth is not in the best interest of any retail investor. Those are the people we're here to serve, and we should give them a choice. NASA has long supported and will continue to support investor choice in this space. Thank you for having us and giving us a part of the conversation. We look forward to continuing with the SEC, IAC, staff, everybody in the future. Thank you.
Thank you so much. And thank you to our panelists for giving us their time and insights today. And I will turn it over to Brian.
Thank you, Christine. That includes our Q&A for today. I extend my gratitude to all of our panelists and our participants for their insightful and productive discussion. We're now going to adjourn for lunch and an IEC executive session. The public segment of the meeting is going to resume at 2 p.m. IEC members, please log off this link and log on to the administrative link for our executive session. That will begin immediately without any break. Thank you, and we'll reconvene again at 2.